U.S. natural gas futures climbed above $3.50 on Friday, extending gains for a fourth consecutive session, as rising flows to U.S. liquefied natural gas terminals improved the near-term export outlook. Stronger export expectations were reinforced by higher natural gas benchmarks in Europe and Asia, where cold weather has tightened supply and increased competition for U.S. volumes. That said, the latest storage report offered a more mixed signal. Thursday's 360 billion cubic feet withdrawal came in below the 379 billion cubic feet consensus forecast, which likely capped upside momentum. While inventories flipping from a surplus to a deficit versus the 5-year average might normally be viewed as bullish, the market reaction was notably muted, in my view. There are several reasons why this shift failed to trigger a stronger rally. First, it is still relatively early in the season to draw firm conclusions from a modest deficit. If inventories remain below the 5-year average after the spring shoulder season, the implications would be far more constructive heading into the summer cooling period. Second, traders appear comfortable with the idea that there is still ample time to rebuild storage. As temperatures moderate, demand is expected to ease while production rises, potentially eliminating any near-term deficit without much stress. As a result, the market has already shifted its focus back to weather. While colder conditions are still expected early next week, forecasts for the remainder of February point toward above normal temperatures, which weakens the bullish narrative. In that context, elevated prices above $3.50 are beginning to attract some skepticism. Without a sustained cold signal, it becomes harder to justify further upside. Adding to that cautious tone, Friday's Baker Hughes rig count showed U.S. gas rigs rising to 130, the highest level since July 2023. This suggests producers remain willing to increase output as long as prices stay comfortably above the $2.70 area. Against that backdrop, the market's pullback below $3.50 following the rig count release at 1 p.m. was not particularly surprising. It reinforces the idea that higher prices may continue to invite supply responses, limiting upside unless fundamentals tighten meaningfully. Prices have recently stalled above the $3.50 area, which is acting as an important short-term pivot. Holding above this level keeps the market in consolidation mode, but it does not yet signal a strong bullish trend. Upside attempts are likely to face resistance between $3.80 and $4, where selling pressure has repeatedly emerged. On the downside, a sustained break below $3.50 would weaken the technical picture and open the door for a pullback toward the $3.20 to $3 support zone. Below that, sentiment would likely turn more decisively bearish. Overall, momentum indicators suggest the market is losing upside strength, and rallies at current levels appear increasingly vulnerable unless supported by a new bullish catalyst. In the near term, natural gas is likely to trade sideways with a slight downside bias, while the broader outlook remains neutral unless prices can decisively break above the $4 area or, conversely, fall below key support. If you found this helpful, consider buying me a coffee or watching ads to support the channel and keep the content coming. Thanks for the support, and I'll see you in the next one.